Hello, this is Jordan, and this video is being recorded on the evening of Tuesday, June 9th, 2020. Thank you for joining me today. And in this video, I'm going to do a quick update on gold against the S&P 500, and I'm also going to include the gold stocks against the S&P 500. So this video, it's just one slide, one chart here. We have gold against the S&P at the top, GDX against the S&P at the bottom. And at the end of March, gold against the S&P made a 4-year high. And then in May, GDX against the S&P made a 3-year high. Now, both have been pulling back for a little while. Gold against the S&P, that's been pulling back for longer. And I've discussed the importance of these ratios in past videos. For precious metals to be in a real bull market, they have to outperform the stock market. If everything's going up at the same time, but gold is not outperforming the stock market, that's not a real bull market. That's like what we saw 2017, 2018, for example. That doesn't serve precious metals well. But the good news is, essentially, since October 2018, these ratios have been trending higher. They've been making higher highs, higher lows. And October 2018, that was 2 months before the Fed shifted its policy. They did their last hike in December, and that was it. Their policy completely shifted. The current correction in these ratios, probably pretty close to being over, but you never know. You can go back and look at the past. Sometimes they correct. They can go sideways for a while. These ratios, they can at times be a leading indicator. So the correction in these ratios is, it may end a little while before the correction in nominal terms ends. So it's just something to keep in mind. If we see these ratios firm up, but gold and GDX and GDXJ, they're still correcting, that's not a bad thing. We like to see the relative strength in precious metals. So, that can be a positive leading indicator. So just keep that in mind. Now, in the bigger picture, gold against the S&P 500, that has 6-7 year resistance at 0.70. The GDX against the S&P 500, it has similar resistance. So, but looking at the gold against the S&P 500, and I'll just end on this because I don't want to babble on forever here, but if you go back to 2014, you can kind of see that there's this long, large head and shoulders bottom developing, where you have the left shoulder, which is kind of in 2015, with that double bottom there. The head is the October 2018 low, and this next low, maybe it lasts for several months, that could wind up being the right shoulder of a huge head and shoulders bottoming pattern, which has resistance around 0.70. If the ratio is able to get above that at some point, that's going to trigger a measured upside target of 1. The S&P 500 right now is what, at 3,200? And if you just look at the S&P 500, at the very end of 2017, I think it got up to 2,800. So that's kind of a level to keep in mind for the stock market. If the valuations are so extreme, it's going to be difficult for it to continue to go higher and higher. Maybe it just gets stuck kind of range bound. We saw a lot of that, in the late 60s and 70s. So, when you think about the S&P 500 trading at 3,200, and then, that level of the last couple years around 2,800, just keep that in mind. And gold's potential measured upside target in nominal terms, if it breaks above 1,900, is 2,750. So if we see that ratio there at the top break 0.70, at some time in the next year, then gold could have a chance to get to that 2,700 target in the next couple of years. So long story short, the big picture here is very encouraging. These are important ratios to watch. And, pay a little bit more attention to these over the next couple weeks because they could serve as a leading indicator for the sector for a potential summer bottom. All right, I hope you really enjoyed the video. Hope you learned something. You can follow all of my work at thedailygold.com. Opt in there for my free book. You can consider my premium newsletter. Get it at thedailygold.com/premium. We focus on market timing and stock selection. I really think there's, not too many, but there's some high quality juniors out there. And I think if we make the assumption that this bull market is going to continue over the next year or two, I really think the next couple of months could be your last chance to get into some of the really lower risk juniors that have potential to go up 3x or 5x in the next couple of years. So that's another thing to consider. Now, if you want to, I already said it. Thank you again for listening to this video. I appreciate it, and I look forward to publishing another update for you guys in the days and weeks ahead.